Hello, everybody. Thanks for joining us for another episode on Prescient On Point Live. Today, I've got Rupert Hare with me. Thanks for doing this with me, Rupert. For those of you that don't know Rupert, he's head of multi-asset at Prescient. And therefore, obviously, today we'll be talking a lot about multi-asset balance funds and take a global perspective on how things have been moving over the last while. And that's important because obviously it has a reflection on how we position the balanced fund, not only locally, but internationally as well. So Rupert, to get into it, before you came on, the last few videos have been with our sector heads, and we've spoken bonds, we've spoken equities, cash and income, and I think obviously in a multi-asset context, it brings all of that together to develop our best investment view in our balanced portfolios. Give us a little bit of sense of how you draw your views from the teams and build up the balanced portfolio.
Right, yeah. So I think perhaps unlike or like a lot of other investment houses, what we do as Prescient is that we aggregate the team approach. So when you've spoken to the other team heads and other team members, we leverage off those house views in multi-asset, and we also collaborate with those teams in building the portfolios that we build. So it's not just about we take a blind view based on what our bonds team has said. We take a view in collaboration with our bonds team, and we build those models out together such that we are trusting of in both directions of the models that we use.
Okay.
Yeah.
Okay, so building that best investment view, in fact, it's not just Rupert and his team building it, that comes from the pillars of each of the asset classes, building out on those models. Rupert, I think just from a product mix perspective, let's maybe cover, we've got a local balanced fund, we've then got the balanced fund that truly looks offshore, 45%, and then maybe just give us a sense of the global balanced fund and even the defensive fund, if you want to, in the context of asset class movements over the last while, because things have been there's been lots of moving parts of the Straits of Hormuz, global inflation rates, etc., etc. How's that played out in the portfolios of late?
Yeah, so as you said, we've got offerings across the spectrum just to try and cater for every investor's need. But all of those offerings follow exactly the same investment approach. That's key for us. So we use the same systems to build the portfolios, be it from a low equity defensive standpoint or a high equity balance standpoint, onshore, offshore, local only. We've got the lot. The views from around the world have been playing into our portfolio positioning. What's interesting for us is that we've got different types of indicators. Some of them are fast moving and some of them are slower moving. The fast-moving indicators, a good example of that, we look at volatility type indicators. And those volatility indicators spiked up on the day when there was the first invasion within Iran. It's now been a bit like a yo-yo because we, at one stage, the United States and Israel are invading Iran, then they're not, then they are, then they're not. And the beauty of the portfolio positioning, how we implement it, is that we are not really bound to any one asset class view indefinitely. So we can put positions on and we can take positions off because of the way that we trade these asset classes. And namely, that's that we don't pick single stocks at all. We trade predominantly very liquid instruments in both fixed income and the equity space, and in South Africa and globally. So we can shift money onshore, offshore, or between asset classes.
Okay. So I guess what you're describing in effect there is you have a strategic asset allocation framework set out for the portfolios, and then a tactical asset allocation strategy that would work to effectively compensate for whatever is happening in the markets.
Right. So we always focus on the strategic asset allocation first. Perhaps that's a bit of a differentiator with other asset managers. We structurally want to achieve the longer term return targets for an investor because we know that someone who is, for example, in a Reg 28 pension fund, they're not investing for 2-3 months. They're investing for quite a few years. So we need to build that in the balance fund CPI plus 5 to 6, the defensive fund CPI plus 4. We're trying to build those inflation protected long-term return estimates. And in doing so, we can build out the portfolio with those expectations on asset classes. That's the foundation. If we were a passive fund, that would be the so-called set and forget foundation of our multi-asset funds. But we're not passive. We do take those short-term views, and our Tier A models guide those anchorings of strategic asset allocations away on either side. And that's not to say we're a flexible fund. I always emphasize this. You can be a flexible fund and you can go to 100% cash in a high equity fund, ironically.
You're not doing that.
We would never do that. We're just going to go 5% less South African equities, 5% more emerging market equities. So thematically, what we've had in the past quarter, or 2 quarters actually, has been a large underweight in particular US equities, highly, highly overvalued, and more of an overweight into the emerging market equity space, which offered quite a good valuation. What's over the last month, what's happened is that emerging markets have run so strongly that that valuation case has largely disappeared.
Okay.
So we've then taken off that overweight in emerging markets. So as I said, dynamic, we can move those asset class views, and we do move those asset class views.
So similarly in the bond space, domestically or globally.
Yeah.
And then importantly, you read a lot of material and they talk about 60/40 portfolios overseas. I mean, I don't think I've ever seen a 60/40 portfolio in South Africa, but we use a much larger breadth of asset classes. And included in the balance funds that you manage, you'd have some unlisted instruments as well, which are portfolio enhancers.
Yeah, so we leverage off our credit team, and you've had a session with Conway already. A section of our balanced portfolio, our defensive portfolio, our local balanced portfolio, roughly 15% of each of those is run within the credit space. 3 different building blocks there. The first being a broad, diversified listed credit exposure. So that's about 100 names, 5% of the portfolio. Second being another 5% towards wind and solar farm type projects. So that's now unlisted debt. And the third is towards infrastructure projects. Again, unlisted debt. Really good return enhancers and a pretty smooth return profile.
Okay. Rupert, maybe just to close off on this short section, give us a sense, what do you expect to play out over the next while? I know that's a very difficult question, and we don't look as a systematic house, we don't talk about forecasting, but just given what you've seen, what could a client expect from their balance fund for the remaining sort of 5-6 months of the year?
Yeah, I mean, I'd love to have a crystal ball, but obviously I'll never be
Tell us
able to
when you know.
achieve that. Yeah.
Yeah.
But what we can say, and this is probably not going to make people any more insightful or sleep well at night, but what we can say is that we expect uncertainty within markets.
Sure.
But we're positioned for that uncertainty. So what we've done is we've taken risk off within portfolios. We've taken a large underweight in US equities. We've taken off duration across some of the yield curves that we have exposure to around the world. And that's not at the expense of returns. I must put that out there. There are pretty attractive offerings, attractive yield profiles at the front end of the yield curve right now.
Okay.
We've got the inflation narrative that keeps on rearing its ugly head.
Yeah.
Once again, it's coming through with this once again invasion of Iran by Donald Trump. So the oil price picks up and that translates directly through to inflation. But that we see as being temporary, because hopefully that doesn't last forever. And inflationary impacts are once off. And once oil does calm down, or even if oil continues to sit at whatever the level might be, let's say oil goes from 60 to 100. If oil's 100 next year, then there's no inflation. So, right, it's already priced in.
Okay.
So we're positioned in line for that type of outcome. If there is an event which were to be, let's say, a large sell-off in global markets, then we're also ready to put risk back on in our portfolios.
Okay.
So positioned accordingly.
So in the systematic context, monitoring all of this on a daily basis, reacting, the strategic asset allocation setup, very tactical to deliver returns. You don't want to be in expensive asset classes, trading and watching the volatility levels, which is, again, as you said, not passive. It's a very active approach. But I think importantly, if you have a look at the long-term performance, particularly of a balanced fund, you're sitting top quartile through all of time. And that's really what the portfolio is designed to do in a multi-asset high equity portfolio targeting CPI +5.
Right. So if you were to pass on a part of Prescient's philosophy into the balance space, that part would be that consistent profile that you get in an income provider type strategy, right? So if you can give that consistent alpha generation year on year on year, you'd be surprised how quickly that compounds you right to the top. And we are, as you say, top quartile. In fact, we're in the top decile of funds since inception, hopefully catching up to be number one in 20 years. But it's now almost 12 years since the start of our balance fund, and we are in the top 5. So we're getting there, and we're getting there not by big swings of the bat. We're getting there by that slow, consistent grind of positive alpha in a portfolio. And it's about the journey, because if we were to take a big bet in our balance fund and get it wrong, then there might be one year where, for example, you might take a lump sum on retirement and our balance fund is down 20%. We don't want that
Mm.
because investors are sensitive to that rolling performance just as much as they are sensitive to that long-term performance.
Rupert, thanks very much. I mean, a good insight. Lots more we could talk about, but this is normally a short video clip. And again, thanks for doing it with me. But before we end, I always ask a personal question. Tell us something that the audience listening doesn't know about you. It might be something that you're reading, something along those lines.
Sure, this puts me on the spot. I've had this in another interview before. Yeah, I guess I'm passionate about asset management, but
Thankfully.
thankfully, my secondary passion would be about conservation. So
Okay.
in doing some work around conservation in South Africa, not just preserving animal species, but also the broader environment. So
Lovely.
that's another passion of mine.
Good.
Yeah.
Rupert, thanks for doing this. And yeah, I hope you enjoyed it, and we'll see you again.